There are 7 things people do with their bank accounts every day that HMRC is now flagging. Not investigating, not auditing. Flagging. That means your name goes into a system, a file is opened, and from that point forward, everything you do with your money is being watched more closely than before. Most people have no idea this is happening. They think HMRC only comes after you if you cheat on your taxes or run a business. That is not how it works anymore. HMRC now pulls data from your bank, from online platforms, from the Land Registry, from pension providers, and from over 60 other sources. Their system is called Connect. It is an artificial intelligence that cross-references everything and it flags you automatically. No human has to make a decision. The machine does it. Here are the 7 bank account moves that trigger it. Number 1. Depositing large amounts of cash without a clear source. There is no official legal threshold in the UK where your bank must report a deposit to HMRC. But in practice, any cash deposit over £5,000 will prompt your bank to ask where the money came from. Deposits over £10,000 are almost always flagged internally. And since July 2024, there is an annual limit of £20,000 on cash deposits into personal accounts. If you sold a car for £8,000 in cash and deposited it, your bank may ask for proof. If you cannot show where it came from, the bank files what is called a suspicious activity report with the National Crime Agency. That report is shared with HMRC. You will never be told it was filed. You will never see it, but it goes on your record. The bigger mistake people make is splitting the money up. If you deposit £3,000 on Monday, £3,000 on Wednesday, and £2,000 on Friday, thinking that smaller amounts will not be noticed, that is called structuring. Banks are specifically trained to detect it. Structuring is treated as more suspicious than a single large deposit because it shows you are deliberately trying to avoid detection. If you have a legitimate large sum of cash, deposit it in one go and keep the paperwork that proves where it came from. Number 2. Earning savings interest above your personal savings allowance. Since April 2016, every bank and building society in the UK automatically reports all the interest they pay you directly to HMRC. You do not have to declare it yourself. HMRC already knows. If you are a basic rate taxpayer, you can earn up to £1,000 in savings interest tax-free. If you are a higher rate taxpayer, that drops to £500. If you are an additional rate taxpayer, you get nothing. Every penny of interest is taxable. The problem is that with savings rates as high as they have been recently, it is very easy to breach these limits without realizing it. If you have £50,000 in a savings account paying 4%, that is £2,000 of interest per year. £1,000 over the basic rate allowance. HMRC will automatically adjust your tax code to collect the tax through your pension or wages. Many people only find out when their take-home pay drops and they have no idea why. If your total savings interest is over £10,000 per year, HMRC requires you to file a self-assessment tax return, even if you have never filed one before. I will put the details for checking your savings interest position in the description. Number 3. Receiving regular payments from overseas. Under the Common Reporting Standard, which the UK is part of, foreign banks automatically share account information with HMRC. If you have a bank account in Spain, France, Australia, the United States, or any of over 100 participating countries, HMRC already knows about it. The balance, the interest, and the account holder details are reported every year. If you receive regular transfers from abroad into your UK bank account, whether that is rental income from a property overseas, a pension from another country, or money from a family member, HMRC sees it. If those amounts do not appear on your tax return, the Connect system will flag the discrepancy. This applies even if the money has already been taxed in the other country. You may still owe UK tax on it, depending on the double taxation agreement in place. Number 4. Selling items online without declaring the income. Since January 2024, platforms like eBay, Vinted, Etsy, and Airbnb are required to report seller data directly to HMRC. If you sell more than 30 items or receive more than £1,700 in a calendar year on any single platform, that platform sends your name, address, bank details, and total sales to HMRC automatically. Now, selling your old clothes or clearing out the garage does not make you a trader. But if you are buying items to resell them, if you are making things and selling them regularly, or if your total trading income from all platforms combined exceeds £1,000 profit in a tax year, you are supposed to register for self-assessment and declare it. HMRC launched a £40 million enforcement campaign targeting online sellers. They are sending what they call nudge letters to people whose platform income does not match their tax returns. If you get one of these letters, it is not a scam. It is real. I will put the guidance on what to do in the description. Number 5. Taking money out of your pension on the wrong tax code. When you access your pension for the first time, your pension provider does not know your correct tax code, so they apply an emergency tax code. That emergency code assumes you will be withdrawing the same amount every single month for the rest of the year. If you take a lump sum of £12,000 from your pension, the emergency code treats it as though you earn £12,000 every month, which is £144,000 a year. You get taxed at the higher rate on a single withdrawal that should have been taxed at the basic rate or possibly not taxed at all. HMRC flags this because it creates a mismatch in their records. They see a large payment from a pension provider, but the tax code does not match your actual circumstances. The overpaid tax does eventually get refunded, but only if you claim it back using forms P55 or P53Z. Many pensioners never claim it. They assume the amount deducted was correct. It almost never is on the first withdrawal. If you are planning to access your pension, contact your pension provider and ask them to use your correct tax code before you make any withdrawal. If they have already applied the emergency code, file the reclaim form immediately. I will put links to both forms in the description. Number 6. Receiving rental income that does not appear on your tax return. HMRC now cross-references data from the Land Registry, tenancy deposit schemes, letting agents, and platforms like Airbnb and Booking.com. If you own a second property, HMRC knows about it from the Land Registry. If a tenant has placed a deposit in a protection scheme, HMRC can access that data. If you list a property on Airbnb, the platform reports your earnings directly. The Connect system compares this information against your self-assessment tax return. If HMRC sees that you own a property with a tenancy deposit registered against it, but you have not declared any rental income, that is an automatic flag. In 2026, HMRC nudge letters to landlords with undeclared rental income are arriving at a higher rate than at any point in the last decade. If you have rental income you have not declared, HMRC runs what is called the Let Property campaign, which allows you to come forward voluntarily and pay what you owe with reduced penalties. If you wait for HMRC to find you first, the penalties are significantly higher. I will put the details in the description. Number 7. Having a joint account after your spouse passes away. This is the one almost nobody thinks about. When your spouse or partner dies, any joint bank account automatically becomes solely yours. The balance does not change. The account number does not change, but your tax position changes completely. If that joint account was earning savings interest, HMRC was previously splitting the interest between two people. Each of you had your own personal savings allowance. Together, that was up to £2,000 of tax-free interest. Now that the account is solely in your name, all the interest is attributed to you alone. Your allowance drops to £1,000. If the account holds a significant balance, you may suddenly owe tax on interest that was previously covered by your spouse's allowance. HMRC does not send you a letter explaining this. They simply adjust your tax code when the bank reports the full interest amount under your name only. Many people discover this months later when their pension payment drops or they receive a letter saying they owe tax. What you need to do is review the savings interest on any account that was previously joint. Consider whether moving some of the balance into an ISA, where interest is completely tax-free, makes sense for your situation. Those are the 7 bank account moves HMRC is now flagging. Large cash deposits, savings interest above your allowance, money coming in from overseas, online selling income, pension withdrawals on the wrong tax code, undeclared rental income, and joint accounts after bereavement. None of these are illegal. Most of them are things ordinary people do every day without realizing HMRC is watching. The difference between being flagged and being left alone is whether HMRC can match what they see in your bank account with what they see on your tax return. If those two things do not match, you are in the system. I will put all the relevant links, forms, and HMRC contact details in the description below. Share this with someone who needs to hear it before they get the letter. I will see you in the next one.